Welcome back to our intermediate financial accounting class. In our last segment, we started talking about revenue recognition, why it's so important, and how it's changed with FASB's new guidelines. And we focused on these 5 new principles that FASB has passed as the way to recognize revenue. We've already talked about identifying the contract and the different things that FASB wants to see for a GAAP contract or the recognition of an actual contract. What we neglected to say was that if you don't have evidence of a contract according to GAAP's rules, even if legally you got one, you can't show any revenue. The next step is to identify our obligations. FASB calls these performance obligations. It's everything that we have promised as the vendor to give to our customer or client. It can be a good, it can be a service. So once we've identified that we have a contract, we need to go through that contract and highlight everything we've promised to do for our client. Now, we're not going to worry about what the client's recording. We're just going to worry about what we as the vendor are going to record. So I'm going to go back through the contract. I'm looking for everything I've promised to do. I'm going to make a list of all of it, and then I've got to evaluate that list to see what is a distinct obligation. A distinct obligation is different than a generic obligation. And a generic obligation is everything I've promised. A distinct obligation stands alone. And you can see down here 2 specific requirements that create a distinct obligation. First, can the customer benefit from that good or service if I don't do anything else? If not, it's maybe an obligation, but it's not a distinct obligation. Second, in the contract, does it specifically say that I'm going to give them this item? So what I'm looking for in this process are not all of the obligations. I'm looking for the distinct obligations, and that's what I'm going to record. So let's use your education as an example, just to kind of get us rolling on this idea. Let's say that you are purchasing from your university a degree. That's what you're wanting, right? And you're paying money to them, and they are going to provide you, if you complete all these requirements, with a degree. So as part of what we're selling you as a university, we're giving you classes and grades, and we're also giving you an experience with the university. Those are our obligations. That's what we agree to give to you. Are they distinct obligations? Well, the courses and the grades are not distinct. You could not just take the course and not get a grade, and you can't get a grade without the course. So even though we're agreeing to let you sit in the class and do the work and give you a grade, I would treat those as one obligation because those 2 are not distinct from each other. On the other hand, the other parts of your education, clubs that you're part of, living on campus, dining on campus, interacting with professionals and professors outside of class, those things aren't necessarily required as part of going to class or getting a grade. So as a university, I would treat this as 2 separate obligations instead of 3, because the grades and the classes, they go together. So that's what we're trying to do with this process. And the biggest issue with this process is that this is based on opinion. So it's going to be you and your team deciding, are they distinct obligations or not, and then having auditors come in and say, well, do we agree, do we not agree? And we're all going to come together and try to argue this out and come to a logical conclusion, because there's no rule beyond, can the customer benefit from it on its own, and have I promised in the contract to give it to them? So let's take a look at a couple of business examples and decide what are the specific obligations or distinct obligations that we're under for each of these scenarios. So first we have Neal Construction Company. They began developing a new set of condos, but realized they needed some additional financing. So they went to the bank, and the bank said, you know, you need to raise some money and then we'll match it. And so Neal Construction Company went out and they sold 1 unit in advance to get the funding that they needed to go to the bank and get the rest of the funding. So what they've decided under this contract is that they will issue or sell 1 condo up front, will allow that person to make minor modifications to the floor plan up to the last 6 months so that they have a reason to buy it early. They've got this flexibility. In addition, we've agreed that we won't sell or even show this condo to anybody else. That spot will be theirs. Finally, just as a general policy, Neal typically offers customers a small discount or refund for anything that's unsatisfactory. Those discounts usually average about $1,500, and this pre-order would also get that promise. In exchange for this, they've agreed to pay us $250,000 at the time they signed the contract. we think we can complete it in 2 years at an average cost of $171,000. So how many obligations does Neal Construction Company have to their client in exchange for this $250,000? And again, right now we're just looking for all of the obligations. Then we'll look at specific obligations or distinct obligations after we've got a full list. Really, we could say that there are 4, at least 4. You could actually name others, but really we're agreeing to give them the condo. We're agreeing to allow them to make changes for the first 6 months. We're agreeing not to let anybody else see the condo because we're promising to give it to them. And last, we're agreeing to give them this discount if anything's wrong at the end. So we've got 4 obligations. The next question, now that we've identified the 4 obligations, is how many of those are specific? Remember, to be specific, they have to be mentioned in the contract and they have to stand alone. Well, in this case, all of them are mentioned in the contract. We've seen them in the details up here. But let's think about this. First off, the condo itself. Could I give them the condo and not do anything else? Yes, I could. Second, could I allow them to make changes to the condo without actually selling them the condo? No. So those 2 are not distinct. I'd have to treat them as one. Third, we said that we cannot show it to anybody else or allow anybody else to see it. We've reserved that slot for them. Could we do that if there wasn't a condo? No. The last one is we allow them to register complaints and we give them a discount if they're not satisfied. So there's this guarantee. Again, could I provide a guarantee without the condo? And the answer is no. So even though we've got 4 different obligations, we've only have 1 distinct obligation because it all hinges on providing them with the condo. Now let's take a look at another example. This is Hansen Company. They produce and install specialized manufacturing equipment. In addition, they've also started to offer their client help finding and buying or leasing property to put the equipment, because apparently they make stuff so big that it was hard for their clients to find a place to install it. So recently they signed a $3 million contract for all 3 services. They're going to produce, install, and lease the facility while they will do the installation. Payment will be made after installation so the client can be sure that the new equipment is working properly. And then it gives us some costs. The equipment typically costs us $1.7 to make. We usually sell it for $2.9. Installation costs about $100,000. We sell it for $300,000. The cost of creating the lease is typically about $10,000. We sell just that service for $50,000. We estimate it will take about 3 months to find a location, get the lease set up, 6 months to produce the equipment, and then 1 month to get everything installed and ready for the client. And we can be doing some of these at the same time. So again, the question is, how many obligations do we have? Well, in this case, we have at least 3. You could argue for more, but really the main ones are producing the equipment, installing the equipment, and leasing the property, or helping them lease the property. So we have 3 obligations. We could also talk about guaranteeing that it's actually going to work, but really it's these 3 big items. So now the question becomes, do they stand alone? And we could argue about this, but really all of these are distinct. We could just produce, I gotta be careful with what fingers I hold up here, hold on. We could just produce the equipment and do nothing else. They could install it themselves or hire somebody else to install it. So just providing them with the equipment stands alone. I could just do the installation. They could buy the equipment from somebody else, or they could try to install it and then come back and buy it from me later if they can't get it to work. So that stands alone. And the leasing, they could hire anybody else to do the lease, or they could just hire me to just do the lease and buy the equipment from somebody else. I could just do a lease. So because of that, each one of these gives value on its own and is a distinct obligation. So we have 3 obligations, and they're all 3 distinct this time. Now, some of you listening to this are going, no, I don't think so. I think we could break it down a different way. If you felt that way, good for you. That's the whole point of this new rule, is that it's debatable. As a company, as an audit team, you have to decide. Is it 3 or is it 1? In this case, we're going to say that there are 3, just because you aren't here for us to have an argument and decide. But as a company, you would really be deciding this on your own. The next part is determining the transaction price. And the transaction price is basically how much we think we're really going to get out of this contract. The formal word FASB uses is consideration. This is everything we get. It can be discounts on services they provide us. It can be cash, it can be a promissory note, it can be interest, it can have a time value component if they're going to pay us over time. There's a lot that can be involved in deciding the actual amount we're going to get. So here's some specific things that we should look at when we're deciding on the transaction price. We want to know what the contract price is, so what's in the paperwork. Is there anything variable? For example, with our Neil Construction Company, we typically give a $1,500 discount, but it could go up or down, so we'd have to think about that. Are there any constraining estimates, meaning that if I get something wrong, they'll pay me less, or they think they're going to order 100,000 units, but they might only order 90,000, so I may not get the full amount, so I'd have to look at that. Is there a financing component? So again, is there a time value or an interest element I need to think about? Are they giving me some non-cash stuff? And if I have to pay anything back to the customer, like our Neil Construction Company having to give back a certain percentage as a discount if they're not happy. All of these things and anything else, past experience, what we've seen with this client, what we've seen with other clients, what we get as a vibe, as a salesperson. Do we really think they're going to do this, or are they going to cancel? A lot of things come together to help us decide what the actual transaction price is. So again, let's take a look at our examples. We want to know what the transaction price will be for Neil and then for Hansen Company. In this case, there's two numbers that we're really focused on. The first is this number. This is what they promised to give us. And the second is that we typically have to give back 1.5 because people are not happy. So if we're going to figure out our transaction price for Neil Construction Company, I would take the contract price, which is $250,000, and I would subtract the estimated refund. And in this case, I have no reason to believe that it will be different than my average, but if I'd gotten the vibe that this was a picky person, I might say, you know, I better make that $2,000, or if I got the feeling that this was a go with the flow, I might drop it. But in this case, I don't know anything like that, so I'm just going to go with my average. So my transaction price will be $248,500, and that's how I do it. Another good example of this that we've looked at in the past is purchasing things using the net method versus the gross method. So the gross method says, I'm going to offer you a 2% discount if you pay within 10 days, but I don't think you will, so I'm going to assume I'm going to get all of my money, versus, you know, I think this person will get a 2% discount, so I'll drop it down 2%. Under the old rules, you would have to choose either gross for everybody or net for everybody. Under the new rules, you do it person by person, transaction by transaction, client by client, however you decide to break it down. And I would say, you know, I've worked with this person before, they always get the 2% discount, I'll go ahead and recognize 2% less. Versus, you know, I've worked with you before and you always miss the 10-day, so I'm going to assume that I'm going to get it all from you. So that's what we're doing. We're taking out what we don't think we're going to get, or adding more if we think we will. Let's look at Hansen. If you look at Hansen's numbers, really, there's nothing surprising here. The contract is for $3 million. We'll finish this in 7 months, so there's no time value that I have to worry about. We don't worry about time value unless it's at least a year, and then only if it's material. That's why with Neil, we didn't get into time value because we figured the difference would be immaterial. In this case, that's our transaction price is $3 million. I see nothing here about discounts. I see nothing about money back or anything, so that's my number. But just for the sake of practicing one other option, let's say that Hansen's contract includes an option for reducing the price or canceling the contract if the customer finds a better deal. Again, this is a what if, just so we can see how this works. Based on our past experience, 30% of clients keep the original contract, 60% get about a 10% discount, and the other 10% simply cancel because they find a better deal. So using these numbers, what would be our transaction price? Well, to do that, we use a table. So I estimate the price I'm going to get and the likelihood of that price. So there's a 30% chance that I'll get all $3 million. Then there's a 60% chance that they'll get a 10% discount. So 90% of $3 million is $270,000. And then there's a 10% chance that they'll cancel the contract and I will get nothing. Now that I know the amounts I'll probably get and the probability of getting each amount, I can get a weighted average price 3 million times 30% is 900,000. 2,700,000 times 60% is 1,620,000. And 10% times 0 is 0. If I add that up, I will use for my transaction price this amount. Everything I do moving forward will be based on this 2,520,000 and not the 3 million, because this is my best guess on what I think I'm going to get. And that's what this step, this part 3, is all about. Determining the transaction price, what I think I'm really going to get. We've gone far enough for right now. When we come back, we'll start looking at how we break down these transaction prices, and then, yes, some journal entries. We'll see you then. Thanks.